Okay, good day, guys. I hope everyone is doing well. I'm just gonna try and test this thing out and see how it sounds because now I don't have a mic on me to record this thing to make the quality of the audio like more or better. I can see. Let's try. Let's go ahead. Okay, guys. I will try and draw something for you here to make you understand the most important things that you need to understand in the market. Most important thing. The first thing you need to understand, you need to understand the market structure. The market always moves like creating things called the higher high and higher lows, higher highs and higher lows, higher highs and higher lows. That's how the market moves. The market will never move like from now. Will never move like that. Never move like that. Always move in this form, creating higher highs and higher lows. What do I mean higher highs and higher lows? It's a high, a higher high, a higher low. Higher high and higher lows. Simple, guys. If you understand this, you'll know when to end. This is a bullish trend. Let's go. If it's gonna be a bearish trend, it's gonna make a lower lows and lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and lower highs. Just like that. Let me draw them for you quickly here. Yeah, it's fine. So if you know this market structure, you never go wrong. You can anticipate what's happening. If you're gonna see high time frame, see what's happening, which trend are we on. If we're on a bullish trend, you know the market must trade at higher highs and higher lows, higher highs and higher lows. Then when you're looking for entries, we're gonna enter here on the what? On the lower, on the higher lows. How on higher lows? Because the structure, the market gonna break the structure. We're gonna break the structure like this, trading a what? A new high. Immediately the market trades a new high. You know what's gonna happen. You know it must come back. A pullback must happen. Wait for a pullback. Then after you end, just like that, you end. It's called this a break of structure. It's a break of structure. It's a break of structure. All these are break of structures. The market is breaking structure, treating a what? A high, showing that the market is continuing to the upside. You see, break of structure. Then the market will always create like, if we find something like an imbalance somewhere somehow here, then this is going to be our entry here. It keeps on breaking the structure. what we look for, we look something for an imbalance, because a market must always fill the imbalances that is left. These are going to be our entries. You see, but I want to show you on the red charts what I'm talking about. Same applies this side. Break of structure, showing that the market is going to continue downside. Break of structure, break of structure, break of structure. Break of structure. Break of structure. Like that, guys. If you see the market on a higher time frame, it's a bearish trend, so you know what to wait for. Wait for something like this. Look for an imbalance, then you wait for a pullback, you enter on the higher lows, on the lower highs, I mean, just like that. These will be your entries. You look for these, then these will be your entries. It's like that, guys. Simple. If you know that, you never go wrong. It's the most important thing, you know, a market structure. These are market structures, high highs and high lows. Then you have something like this. You have something like this. Maybe the market goes like then what do you do? Yes, it's a bullish trend upside. What would you do? This is a consolidation. This is what's something called a consolidation. The market was moving up, then it consolidated for a while here. Consolidation. All this is consolidation. Yeah? So what do we wait for? We wait for something like this, a pullback. Looking for buys, for sure. Looking for buys. Then market must come back and tap there and continue to the upside. So where will be your entries? You wait for an imbalance. Look for imbalance there in the lower time frames. Look for imbalance there, then you end from the imbalance. This will be your end, but on the lower time frames. Enter here on the lower time frames, feeling what the imbalances that is created by the market, by this impulse movement, because you know the market structure. The market structure will always be like consolidation, expansion, break structure, creating a new high. This might be a new high. Let me write it for you. This is going to be this is going to be a higher high. Then it comes back, pull back, and fill all these imbalances as is left by the market. You enter lower time frames, then you hold until here. You can hold until here, or depends. Let's do it on the other way around. We call it continuation pattern, that one. Now the downtrend, mind will do like this, comes back, breaks the structure, then comes back, same thing, price market structure, price cycle consolidation, first in consolidation, break structure, leaving imbalance, a retracement. The market must retrace and fill all the imbalances that is left there. Then we end on the lower time frame. me show you what I'm talking about. If you want to short it from here, then it's gonna be like our TP is gonna be like just above the wick. If you find a wick, just above, give you like, because sometimes the spread gonna take you out because of the spread, even if you knew the direction of the market, but since you didn't give a room for a spread that take you out, so it's very important to leave just a breathing gap there, just below the wick there. So that's it, guys. If you understand this is a continuation patterns. If you understand this, you are more likely to make money. Understand this and wait for confirmation entries, because most people, like, they understand this, but they can't wait. They don't have patience to wait for the confirmation entries on the lower time frames. Just because you see a supply or a demand doesn't mean that you should enter there. No, you can't enter just because you see a supply or a demand. No, you need to wait and look for confirmation entries on the lower time frame, then you will enter to avoid like unnecessary losses. Because most supply out there, most demands will be not respected, will be broken. Then just because you see a supply you enter, then you lose. You can't be like that. Wait for a confirmation entry. I can't emphasize that a lot and much. You need to wait for confirmation entries. And if you wait for, you will put your stop loss just below there. Even if it breaks, okay, if it breaks, like, then you lose. Okay, it's fine, but you have no where is your stop loss. You lose. I don't know how. Depending on your what, on your lot size. But sometimes maybe the news or whatever, it breaks there, and what happens next? Something like this will happen. Because I've seen this. Breaks there and comes back. Then if this happened, don't feel bad. It's not your fault. Because this had happened a lot of times. A lot of times. It's not your fault. Your market took you out. It's fine. Don't revenge trade. I knew the direction. Why? No, don't. You took me out. It's fine. It's fine. Don't revenge trade. I knew it. I will enter again. End up entering, end up losing like the trades. Just don't, guys. Just don't. It's fine. Took it out. It's fine. It's fine. This is a continuation patterns, right? I'll show you something else. We have something called this one. It's a something like this. What do we see here? First thing, consolidation. Consolidation, expansion, break the structure, right? Broke the structure, retracement, then fill in balance, then it's done. These are reversals. You see? It's a reversal structure. Let's say if it's a bullish trend, sorry, yes, and then something like this happens. What do we see here? Same. Consolidation. Consolidation. Expansion. Expansion, practice to expansion, practice structure. Then imbalance. Feed imbalance, then enter. Always you enter like this. Always enter on the what? On the week there. Like that. If you understand this concept, you will, and you can see it, you can spot these things like on the charts. I'll teach you how to spot this thing on the charts. You spotting this thing on the charts, then journey will be much easier, I can say, because you understand everything. If you understand these things, you are better than the average traders out there, because most traders, they trade like their own way, but if you fail to follow your rules, like you are the same as other traders there. You need to be different. For you to be different, you need to have rules and follow the rules. Because most people there, they have their own rules and stuff. Okay, cool, but they keep on failing on following those rules, because the rules are meant to protect us from losing trades or whatever, from losing money. Stop loss, always, you can't enter a trade without knowing where is your stop loss. I personally, I always put my stop loss there. I can't enter without knowing or putting my stop loss. I can't, and I won't. I will never do that. I will never do that. Stop loss, always, because I know the market. The market will not always go according to what I predict or what I say. Sometimes the market will break, and then what? I didn't have stop loss. Then I lose more than I expected or I planned to lose or to risk. But sometimes I lose. Yes, sometimes I lose. Sometimes I lose on the market. But that doesn't mean my strategy or my rules is wrong. No, because many people, when they encounter losses, they tend to change strategies. Nah, don't do that. Stick to your strategy. Stick to your strategy. Sometimes you will lose. You have bad week, bad day, bad month. Yes, that happens to most of us as traders. But don't change strategies every time, every time. Yes, sometimes you just need to adjust there and there. Okay, cool. But do not change the entire strategy, because you never draw in that. I'm not saying this strategy of supply and demand is the only strategy out there. No, I'm not. There are a lot of strategies out there. There are patterns, there are what you call it, there are support and what? Support and resistance. A lot of strategies out there. And people make money using their own strategies. Those strategies. I'm not saying they are wrong, but me, I prefer this one, because this is the one that made me to be profitable, like I say, to be profitable and be able to understand like why I'm doing this. I understand exactly supply and demand. Supply, demand, like the market. For you to buy something, you need to know why you're buying this. For you to sell something, you need why. Is there supply or is there demand of whatever you are selling? All these things, a lot, guys, a lot. But I don't want to go into details now, because I don't want to complicate things, because I want to make this thing simple as possible, because many people use like they use what you call it, averages and stuff. I'm not saying it's wrong. I'm not saying. For me, it was For me, it was complicating. Yeah, it's complicated a lot. But this made things easier. Made things so easy. Now I stick to it. Now I understand it. Now I can make money. But one thing, people think that that's because you are making money, you don't have losses there. Yes, I do make losses. But one thing I would advise, one thing I've done to know how to minimize those losses. If you can minimize your losses, then it's fine. One thing I can say, I can make six losses in a row. I will trade 6 times in a row and make losses 6 times in a row. Then I will not blow my account. Nah, because I know how my risk management, loss size, stop loss. I know that because many people try to flip their accounts like in one trade, then tend to lose a lot there. Don't do that. Don't do that. Because if you try to flip your account in one trade, yes, you can, you surely can. But is the risk management correct there? Is the risk management, because some people increase like the loss size, because they want to make money right now on this trade. Nah, always if you have this amount of capital or whatever in your account, if you lose this trade you are taking right now, are you going to lose everything that you have on your account? If so, don't. That's not risk management. That's poor risk management. You lose if you're taking a trade. Think, okay, if this trade goes against me, how much I'm willing to lose? 10% of what I have, 5% of what I have. It depends. How much do you have? So don't. I don't call it. I don't know what else to call it. Don't do that. Don't, man. Don't, because you never grow. Like you lose everything you had. Everything. Maybe you have made profits maybe for the past few weeks. Then just one loss you take, you lose everything. Everything you have worked for, you lose it in one trade. Nah, don't do that. Don't do that. So I will teach you guys, I will show you how to spot these things on the on the charts. First thing is this reversal, structure, consolidation, expansion, retracement. Okay, and these ones as well. These are continuations. Consolidation, expansion, retracement, tap, balance, then see. Then is this one. Market structure. Very important, guys. I'll show an example here quickly on gold and marked it. This one was a 4-hour time frame, was here on a 4-hour time frame. Simple, guys. Simple. Same as what we went through. It's very simple. Okay, so what do we have here? Okay, the market was going like from here and it came here, consolidation. The market was consolidating there. Sometimes we find imbalances. Sorry, we find doji candles, the candles that are with wicks and minimum body. Those we call doji candles. We find them, and that we can mark them as another kind of consolidation, because the price was there for a period of time, maybe 4 hours and stuff, on the same price, on the same level. Then after this impulse movement took place and it broke the structure, the structure was broken, this one. So price was here for how many hours? I don't know, maybe days or something. Price was consolidating over here. Then impulse movement. See this candle? the impulse movement from here to here. That left imbalance. Let me show you this. Let me remove these things for a second here. Let me remove this for a second. See, this red candle, we say it's an doji candle, can see. Then there is imbalance. What is an imbalance? An imbalance is when the market is only there, the buyers are present here. Only buyers are present on this candle. Only buyers, no sellers. Buyers. Then this is call it an imbalance. So this candle, this red candle here, we can mark it, and we say the market must come back and fill all these imbalances here. These are all imbalances from here. From here, we'll show you. These are all imbalances from here and here. All the space between these two lines, there is an imbalance there, and the market must come back and fill all these imbalances until here. Look what happened. Look what happened. Consolidation, expansion, break structure, leaving imbalances. Then market must come back. We call it a retracement. It retraces back to where? To those imbalances. Fill them, then continues to the upside. Beautiful. See? Beautiful trade. We should have made a lot of money there, and made a lot of money. Before you remember most important thing, you can't just I see a supply or I see a demand there, okay, I will enter. No, you can't do that. You need to go to a lower time frame. Go to 1 hour and see what's happening before you enter. See what's happening. Okay, we have filled, we have retraced, came back. What we have here, where is it? Where is it now? Okay, we must find a clear indication. Now, okay, now the market is reversing now. We must find a clear indication on the lower time frame. It can be a 5-minute time frame or 15-minute time frame. Depends. And say look for entries. And look for entries. You can find it maybe on a 30-minute time frame. I don't know. It depends. I can't say ish. Now this thing. You need to know what we are looking for. It's too far. Maybe it's only 5 minutes time frame. I can't see it there. But yeah, you need to go to that time frame. Enter there. Enter exactly, because you end up losing or entering too early. Then you lose a lot of money just because you entered too early. So yeah, that's it, guys. I'm gonna show you other examples on the charts about how to see these things.